Welcome to our seminar, IFRS 16 and COVID-19. The reason for this seminar is to have KPMG inform you about the recent changes in IFRS 16 and to guide you through how you can account for the changes in share control contract and IFRS 16. Some of the changes are new, and share control has a new calculation model ready for you to take care of the changes. Please also note that the changes in IFRS 16 are not yet endorsed by EU, and they're not expected to be endorsed before third or fourth quarter this year. We'll come back to that. We'll first welcome Serje Fjærvoll, partner in KPMG, followed by Terje Glesåen, CEO in Share Control. We will open for questions after the presentation. Please enter your question in writing in the chat box here. I will then pass the mic to Terje Glesåen.
Thank you for joining. As Caroline mentioned, we have made a new calculation file that take care of the changes. Even though this is a relief from IFRS, we needed to make some changes in our calculation model, which you will see later in the presentation. We also have made some other improvements in our registration system that you will also see, where cash flow, it's much easier to register and changes in cash flow, which will make new payment structure much more easier to register. We will, as always, give you an updated guidance that includes the changes that we made. And I just wanted to stress that registration is easy, but understanding the effects that Serje will go through is more challenging. There will also be some other improvements in the new version. We will have a sublease functionality in the Pro version. We have improved the registration of currency, where we will have income statement caption to the average rate and make foreign exchange adjustment in the footnote. And there is more options in the calculation type template and more calculation. We have some new customers with us. For them, I just want to say that we are confident that we can take care of the calculation and you can concentrate on the input. And implementation is quite straightforward when you have the data available. So then we will change to Serje.
Thank you, Terje. We will start first with some of the basics, just as a reminder of the initial measurement. Then we will talk about remeasurement and modification, which are different things, and how we are supposed to account for that. All this will lead us up to the amendments that IASB has made to IFRS 16. And we will also give some examples of some changes. And these examples, Terje will also show how share control will fix those in their solution. After the examples, we will briefly about government assistance and then impairment before the questions. So we start with the initial measurement. So, as you all probably remember, for the lease liability, there are some key inputs. We will talk about two of those. Those to the left at the bottom is the lease term and the lease payments. These are important inputs. For the lease term, you remember that we include the non-cancelable period, and if there are options either to renew or to terminate, you need to evaluate if these are reasonably certain that you will exercise an extension option, or if you are reasonably certain that you will not exercise a termination option. If you can conclude on one of these, you will include the optional periods. We will give some comments when we look about remeasurement, about maybe you will need to, or maybe you are evaluating if you need to change your evaluation now about options to a remeasurement. We will give a comment on that. To decide if you include, options, you need to evaluate economic factors. economic factors that give you a reason to, for example, include an extension option. That could be, for example, contractual market, which often relate to what you have to pay, either to extend or to terminate, to find a new lease. These can give you economic incentives. But often what we see is that the asset in itself may be determinative in your evaluation. So maybe especially the nature and location of the asset. If it's an office space in a central location, you will probably not conclude that you have an economic incentive to extend, for example. If you have, for example, made significant improvements that you will lose if you move away, that can be an economic incentive for you to utilize an extension option. Then one of the other key inputs are the lease payments. You probably remember that you will include only fixed payments. It's only fixed payments for the lease itself. So you do not need to include non-lease components, but you are allowed to do it if you can conclude that these are fixed. That could be, for example, common cost or maintenance. But our evaluation is normally that these are variable. When they talk about fixed payments, so if you have a payment that depends on your, say, revenue, but it could be zero if you have no sale, and your lease payment may be zero, even though you always have had a sale of some amount, so you believe that you will pay more. But in that case, it's not fixed. Then, of course, termination option, purchase options, all these need to be consistent with how you evaluate your lease term. So these are the inputs. So then we will talk about remeasurement and modification. All we are talking about here is from the lessee perspective. So what is a remeasurement first? A remeasurement is changes to some factors or input that are part of the original contractual terms. And that may not be easy to decide if they actually were part of the original terms. For example, a contract clause could include a force majeure clause that you haven't thought about earlier. But if there is such a clause, and due to that clause or the laws that surround your lease contract, if that's those terms that determine that you get, for example, a rent relief, then it was part of your original contract, and then we are in the remeasurement part. If not, we are in the modification that we will talk about in just a moment. But for the remeasurement, some of the changes will make us have to change the lease liability. You see at the top. There are two, say, broad instances that can happen. If you have a reassessment of the lease term for a purchase option or a residual value guarantee, that will make us have to change the lease liability. Reassessment of lease term, you remember that we just spoke about that the lease term also could include options. So if you have included in your lease term an option to extend, or have not, or I assume that you will not exercise a termination option, then maybe you see that COVID-19 has made some changes. Maybe you don't use the asset as much, or it doesn't generate those revenues that you expected. Then you can ask yourself, okay, do I have to reassess this option? IFRS 16 gives us some guidance there. They say that you should reassess these options only when there is a significant event or significant change in circumstances that are within your control as a lessee. So COVID-19 in itself is not within your control. So you do not have to make a reassessment just because of COVID-19, but you may have done some other things that's within your control. For example, you have stopped using the asset or made a restructuring. In that case, you may conclude that there is something within your control that makes you do a reassessment. And of course, also if you actually do a change that you do not utilize an extension option, or you do not terminate that you have originally assumed, then you need to do a reassessment and a new calculation. When you do a reassessment, you change the lease liability and you also adjust the asset with the same amount. The other change that you probably already have experienced is that you have variable lease payments that could depend on an index, a consumer price index or housing index, whatever it is. When that changes, you need to update your liability and asset. If it relates to future periods, you also adjust the asset. Then you have all other changes, that is remeasurement and not modification. Those are variable lease payments. For example, that you have a lease payment that varies based on your revenues. These variable lease payments you recognize in profit and loss as they occur. When we, in a moment, will talk about these changes to IFRS 16, we will often do an accounting that will be similar to this variable lease payment accounting. So we have talked about remeasurement. But there could also be a lease modification, and as it's defined at the bottom, a lease modification is a change in scope or the consideration that was not part of your original terms and conditions. And that, as we mentioned about, for example, the force majeure, that can be a difficult evaluation. But if you have a change to the contractual term, that is a lease modification, you need to evaluate, okay, what are these changes? If we start up left, so you can have an increase in scope by adding a right of use asset. You can have two accounting. You have to evaluate if this addition is at standalone price. If so, it's a separate lease. If it's not at the standalone price, you need to remeasure the total contract, remeasure the lease liability, and adjust your assets. For this calculation, you will also use a revised discount rate. You could also have a decrease in scope. If you take away part of your asset or if you reduce your lease term. Then you have to remeasure lease liability and adjust your asset, but also you need to calculate and account for a gain or loss or partial or full termination. Share Control has a solution that calculates this for you. Then you have all other lease modifications. These are accounted for as remeasurement of lease liability and your asset. I can comment that a deferral of payment, that is not a change in consideration. So if you have only a deferral of payment, you do not have a lease modification. And actually you do not have to do any accounting either. Conclude this part just to say that for some of the changes you need to use a revised discount rate. For example, change the lease term or if you have a modification. For some, you do not change your discount rate. As you may have understood from this, it can be difficult both to decide if you have a modification or remeasurement, and also to do the calculation and, for example, also decide your new discount rate. So IASB has made a very quick change to IFRS 16. It was effective for 1st of June 2020. It's optional to use this amendment but if you use it for all or part of your lease contracts, you need to use it retrospectively from 1st of January 2020. After we show the examples, we will also give a comment on the EU. For those that had IFRS adopted by the EU, there is an issue in this relation. So, what is the amendment? The amendment to IFRS 16 give an option for a lessee. There's no relief for lessors, but not to account for rent concession as a lease modification or a remeasurement, which it also could be. But there are some requirements to be able to use this option. First, it needs to be a direct consequence of COVID-19. And the revised consideration must be substantially the same or less than the original consideration. Substantially the same means that you can have an increase if that increase is to compensate for the time value of money, to compensate for an interest. But above that, if you have an increase above that, then you will be outside this relief. There are more. The reduction in lease payments need to be or relate to payments that were originally due on or before the 13th of June 2021. And at last, there need to be no other substantive changes to the lease term. So you cannot use this, say, opportunity to make other changes to your lease, or you can do, but then you cannot use this change to IFRS 16. If you elect to use this relief, you also need to provide disclosures that are described in the changes. Okay, so what does this mean for your accounting? If you do not do a modification accounting or part of your remeasurement accounting, you will typically account for it as a variable lease payment. If you remember when we talked about remeasurement to the right, there was a variable lease payment column. So for a rent relief, if you have a rent relief that is unconditional, you will calculate the present value of that relief and de-recognize your liability with this present value, and the same amount you will recognize as a gain in your profit and loss. If it's conditional, for example, that you will only get it, say a month or a quarter, if you have a reduction to your revenue or some other, it's not unconditional, it's conditional, then you need to wait to account for it until it becomes unconditional. We mentioned rent deferral. So if you have a rent deferral, you actually do not have to do any accounting. But we believe that a possible or maybe a practical way is to because there could be a present value effect, that you recognize that present value effect as a reduction or an adjustment to your liability, and also with the opposite effect to profit and loss. But if you have a rent deferral, we also expect that the amount will be quite small. For the asset, there will be no change. We will have one example where we change the depreciation. But if you have a rent relief, there may be an impairment indicator, so you may have to do an impairment test. We will discuss that in a moment. Okay, so we have some examples. We actually 4 examples. B is the same example but with a twist. So which one will qualify? We have in the example, we have original rent of 10 fixed per quarter, paid on the first day of the quarter. The remaining lease term is 5 years. There are no other changes than stated in this example. So the first example is that you have no rent payable in third quarter 2020. That is clearly qualifies for the exemption. In B, you have no rent payable in this third quarter, but you pay extra in the third quarter 2021. The third quarter 2021, that is after 30th of June 2021, but that doesn't matter because the relief or reduction is before June 21. So if the lease payments are substantially the same, you still qualify. So in B1, obviously, you qualify. In B2, you see there is an increase with 1 in Q3 2021. Then you need to evaluate, okay, is this a substantial increase or is it just a compensation for time value of money? If you conclude on the latter, you are still within this relief and can account for it according to this change. Example C is that you do not pay rent now in the third quarter, but you add a quarter at the end after the 5 years, and you add that you both pay and you are able to use the lease for another quarter. Then the evaluation is this a substantial change? In the basis for conclusion for this change to IFRS 16, they said that in this example, if you have 3 months that you add at the end, that is not a substantial change. So in this case, you still comply and can use the exemption. So if there are other changes, you need to evaluate if these are substantial changes. The last example, you do not need to pay any rent from 1st of October this year to October 21. That is after June 21. So in this case, you cannot account for it according to this change. And you cannot account for any part of it. So you cannot split it up and account until June for it under this and the rest after June. So you cannot account for it at all according to this change. Then for those of you that prepare accounts that the IFRS approved by the EU do not expect to approve this change before 3rd or 4th quarter 2020. Then as a strict interpretation, you cannot use this exemption before the EU has approved. So depending on where you are situated, you need to evaluate, okay, what will the local FSA say about this if you are listed. In Norway, we believe that the FSA will not object that you take it into use, but you should evaluate this and maybe discuss also with the auditor for your issue. Terje, should we look at these examples in share control?
Yes. Okay, we are now on the front page of share control IFRS contract in IFRS 16. Before we start, I just want to remind you about our guidance. You find our user guidance under this link, and we will soon issue a guidance with the reassessment modification and this amendment in IFRS 16 due to COVID-19. So the examples I will walk through here, kind of all you need to do will be in the user guidance, so you can look up there later. Okay, this is the contract that Serge presented. It's a contract that you pay 10,000 each quarter, quarterly payment. This is the new registration picture, and we just added an option. And the contract is from 2018 to the end of 2025. Discount rate is 4%, and it's a prepaid lease. So this contract is not in a draft, and we turn on the change log, so now you can start to make the changes in situation A. We first have to enter a date, and we do need to have a date before you make the first change, because discounted cash flow is always forward-looking, so we can't make a cash flow on a date before you make the first change. So if you start to make changes already in first quarter, you have to have a date in January to get this correct accounted. But situation A is from 1st of July, so we are fine to set today. And what you need now to do is you have to write COVID-19 like this, or you can write it like this in one word, but don't use a space, because then it will ignore. If you want to add some more, you can put a semicolon, and you can add some more comments that will be in the calculation. You now see that we have a cash flow. This is the new registration picture that will be available for you after the update, and this contract ends at the end of December. So what I'm going to do first, I'm going to put in some extra periods here, and I recommend that you start to copy the periods that you actually need to register this change, and you need 2 extra periods. We will first stop the first period the end of June, like this, and then we will add another period to the end of September, like this, and the payment in this period will be 0 instead of 10,000, and then we just quickly change the change date. And now we have registered the new cash flow from this lease, which has a 0 payment in third quarter this year. And of course, we don't visit the discount rate because that remains the same, so we just keep that. So what we do is that we have to write COVID-19, we have to register the date that has to be for the change in cash flow, and we have to modify the cash flow. And then we just click save, and we're done. We then go to the calculation, which are here, and we can look at the first case, and we just start to review the cash flow and see that this is correct. Just want to remind you again that if you do something wrong in the cash flow, you have to go back to SharePoint, and you have to roll back to the right version. So now we can roll back and do this over again. So you have always the possibility to go back. We have now registered a change in June 20, and we see the net present value is 9.9, and we have the comment that this is a cash flow change and a modification exception. And you can see that you can always review the cash flow before and after the change. Looking at example B2, we have done a similar registration in SharePoint. The cash flow is now approximately has now increased in third quarter from 10 to 21,000, and we have no payment in the third quarter 2020. And we see that the cash flow, the gain is very low because we compensate for not paying rent. But if you want to measure your lease liability correct at each close, we still recommend that you make this change, because you see your lease liability remains the same until you make this extra payment, and after that it will be equal with the original terms. We can then look at case C. In this case, we added an extra quarterly payment in the first quarter of 2026, and we have the cash flow effect here. But you see in this case also the depreciation has changed slightly because we have added another quarter. So that follows on the bottom of the lease contract. The last is case D, which was outside the amendment, and we therefore have not entered the COVID-19 in the change comments, and we have there is no payment for a year starting 1st of October 2020 to the end of September. And you see here there is no gain and loss. This column is left out, and the change as reduces the right of use asset and reduce future depreciation of the right of use asset. So there is no immediate gain. Just show you that there is some disclosure requirements, and you need to disclose the gain and losses. And of course, if you look at the reconciliation sheet, you can see the total gain and losses of all these contracts that we have made these amendments to. So that should be quite straightforward to gain this information if you use share control. So that was all I had. Just remind you that you will have a guidance where we will in detail go through these examples and all the relevant examples. Okay.
Yeah, thank you. So the last two items that we will quickly mention is government assistance. And of course, there are different government assistance or government grants in different jurisdictions. So I will only mention the one that is in Norway. In Norway, the companies can apply to get coverage of some of their fixed costs from the government. That is a government grant. Some of the fixed costs could be lease payments, so that's within. But coverage of these lease payments is not within IFRS 16. So the accounting has to follow IAS 20 government grants in this case. IAS 20 say that you do not recognize government grant until it's reasonable assurance that you will comply with the conditions and that you will receive the grant. When you can say yes to those two, you can start accounting for this. And this is a grant that relates to income. Actually, it relates to coverage of a cost. So it relates to a P&L amount. So you present that as part of your profit and loss, either separately, for example, as an other income, or you could deduct it directly from the expense it is supposed to cover. If it's significant, you should in either way provide information of these amounts and where they are accounted for. You recognize them in profit and loss on a systematic basis and over the periods for which you recognize the expense that they are supposed to cover. So this is what we call a matching of, say, expense and coverage of expense. Other jurisdiction could have other government assistance or government grants. So you could discuss with your local KPMG if you wonder what this is. It could be also, for example, a tax relief that is accounted for under IAS 12. So some judgment may need to be done. The last thing is we will mention impairment test and IFRS 16. So this slide contains a lot of information. You remember that when we implemented IFRS 16, we increased then the assets and the liability. So we actually got more assets to test for impairment. And according to IFRS 16, we use the standard IAS 36 for an impairment test. But first we need to evaluate if there are impairment indicators. And COVID-19 in general, it could be an impairment indicator, and you may need to do an impairment test. So previously, before IFRS 16, you used IAS 37 and evaluated if you had an onerous contract, say a loss contract. That doesn't apply anymore, but it could be a part of the contract that still need to be evaluated if it is an onerous contract. For example, these common costs or maintenance that you need to pay, but that is not a part of your right of use assets. If you have any of the changes that we discussed earlier in this webinar, you need to account for those before you start doing this impairment test. As mentioned, IFRS 16, we got increased assets, but the cash flow we use in that case to test this higher asset will also increase, because the cash flows that are payment of lease liability will not be included as cash outflows in the impairment test under IFRS 16. One of the important inputs is also the discount rate, which is often the weighted average cost of capital. We believe that this weighted average cost of capital should be lower than what you used before implementation of IFRS 16, and that is because there is lower risk in your cash flows. We still believe that it could be difficult to find market data to calculate this discount rate. So we still believe that for a period, you can use your old way to do the test by assuming that the cash flows, including payments for lease liabilities, are operational cash flow, and that you do not include right of use asset in your impairment test. There are some other issues also that you have to think about in an impairment test. One is that the payments that you have included in asset are only the fixed payments. So there will be variable payments also for non-lease components, and it could be variable payments for the lease, which depending on the revenue, or for future index adjustments. These variable lease payments need to be included in your cash flow in your impairment test. Also remember that the lease liability is only included for the lease term. So if you have an impairment test that goes longer than your lease term, you need to make an assumption either to enter into a new lease or to make a replacement investment for that lease. So if not, you will include much better cash flows than you actually will have. The last thing I will mention is that you also need to evaluate what is your cash generating unit. Often the lease will be a part of a larger cash generating unit. Then you will do as we talked about, but you could have that the lease in itself is a cash generating unit. For example, if you rent some office space that you sublease under an operational lease, in that case, especially you need to think about your discount rate, because a weighted average cost of capital could give you a too high discount rate. There are many things to think about also in an impairment test. We will end with say that KPMG has a lot of publication. Just a few hours ago, we issued a new up to the upper right hand side corner about rent concessions, which discuss this change in IFRS 16 and also give some examples, possible examples, and also talk about this remeasurement and modification. Just to end, for those that are in Norway, there are some contact details for some of us. Me, I'm on the left hand side at the bottom.
Let's see if is there any questions.
There's actually one question that just arrived.
Oh, great. The question is, if you need to wait for the IASB to approve the amendment, do you treat the adjustment as an amendment for Q1/2 or 1 and 2, and then reverse this in Q3 and 4 when it has been approved?
Yeah. So yeah, I can answer that. So it's the EU that needs to approve it. IASB has approved it, but if the EU has not approved it and you do not account for it in the Q2, then you need to follow to find out is it a remeasurement or a modification, as we discussed, and account for it in that way if it's material. If it's not material, you can do other valuations. But then when it's approved, say in Q3, or when you publish your annual financial statements, then you may elect to use this exemption. And in that case, you go back and restate and do a new calculation and account for it under this relief. So then you actually change your previous accounting, and you can go back to 1st of January 2020, but probably your reliefs start at the earliest in March.
Yeah, if it's not significant, you can always put the change in, as we mentioned in the share control, you have to take a date earlier than the change. And of course, the change will then be implemented in the accumulated figures. So you can then account for all in Q3 if you feel that's the right way of doing it, depending on significance. Or the other option is to restate. But in Norway, I think we are quite comfortable that you can do it. Yeah, I think that was all the questions. Caroline.
Well, thank you so much, everybody, for joining us for this seminar. And thank you to Sadia and Tadia for sharing your expertise. And we look very much forward to seeing you at our next webinar. And of course, all of this information is available, and the booklets will be available as well. So until next time, thank you so much, everyone who joined this.